Hey, y'all.
Hey, how's everybody doing?
Fantastic today. My background don't look so cool, but I'm cool.
Well, that's all right. We have a guest today, a guy named Julius Hall. He's still here.
Oh Lord, I don't even supposed to be in here today, and I want to make sure that y'all
Oh,
gonna give me some
look at Julius
correct
Hall.
advice. And I'm just a looking, don't even see myself. Y'all go ahead.
That's what happens when you're live.
Thought he was a new person. What's up with everybody today? Welcome, welcome, welcome. Good afternoon, everyone. Good morning, if you want to say good morning, and welcome to your show because this is definitely your show. It's called Financial Sins, the new podcast on the All Things Relevant media platform. Hey, we're excited about you joining in the conversation every Friday at 1 p.m. right here on All Things Relevant media on Facebook and YouTube. So make sure you check us out after the show as well on YouTube. I'm Mad Flo, and y'all know I'm not crazy. It just sounds like that word means crazy. All it means is I'm making a difference for life and others. That's what Mad Flow means. That's what it stands for. And basically, that's what we're here today to make a difference in everyone's life who listens to this podcast and can obtain some good knowledge on finance. I'll tell you a little bit about me. I'm a retired police lieutenant with an honorary title called captain from the original Chatham County Police Department, right here in Savannah, Georgia, Chatham County. I'm so excited to be here. Married, have three absolutely fantastic daughters that has given me three fabulous grandkids. Now, I'm also a financial educator, which means I teach finance. I teach people how to understand how to make money work for them with a company called World Financial Group, and which is a World System Builder, which is a subsidiary of a division of World Financial Group. Enjoy doing that so much. That's why I do this every Friday at 1 o'clock. And now I want to introduce you to, or let you meet two of our other hosts, Tanya Scott Pilcher and Anthony Murray. Tanya, tell us about you.
Good afternoon and welcome to Financial Sins. I am Tanya Scott Pilcher, business owner of Get Skills, where we help people establish a new career in a $1 trillion industry so that they can live their dreams. And through professional development, training, and coaching, we will help people reach their full potential. So you have nothing here but a bunch of trainers and those of us that take our business very seriously and getting people prepared for the insurance world. In the past 2-3 weeks, we have brought in 19 new people who are excited about reaching their financial goals and making their first steps into financial freedom. So I invite you to reach out. We're here in Savannah and we are reaching our goals and we're changing lives and changing incomes. I am also married to a wonderful husband named Tyrone for the past 25 years. I have a son who is into auto insurance and homeowners insurance, and a wonderful daughter that's 14 years old who is also homeschooled by yours truly. So again, I welcome everyone today. Training. We do it from the cradle to the grave. Hey.
Amen. That's right.
All right, Anthony, it's on you.
My name is Anthony Murray, and I'm honored to be with these wonderful ladies, Mad Flo or Florence and Tanya. No, they're just really two top-notch professionals in this industry. A little bit about my background. My college major was actually in this area, insurance and real estate. Although I'm not in real estate anymore, I sold real estate for 12 years. But in the insurance industry, I had opportunity to work with a couple of good companies. One called Mutual of Omaha. You may be familiar with them. All right. And another one called Edward Jones. So I had opportunities. I've been around a little bit, been dibbling, dabbling in the industry since 1981, I believe it was. So there's a lot of good things that we want to talk to you about. I am a financial literacy educator, and so we teach people how money works. And we help people that are interested in getting into the industry. If you want to get into the industry, we will bring you all the way from infancy or the beginning of learning this business all the way up to the mature aspect of it to where you are either profitable or you gain the knowledge that you want, because not everybody get into this industry for the money. Some people get into it just so they can understand what's going on, and we strongly recommend that. In our organization, I'm with World System Builder, who's owned by World Financial Group, who is part of the Trans America Company and Aegon. And so we're very well established. They're a multi-billion-dollar organization, which is extremely important. Multi-billion-dollar organization. Now, just to tell you a little bit about, remind you a little bit about what we've been talking about. If you remember, for the last couple of weeks, we've been talking about different areas of insurance and how important it is prior to that, how important it is to have a will or a trust. If you could afford a trust, definitely do that. But if not a trust, definitely do a will. I mean, that's the least we could do for our families, right? Is a will. So we've been talking about that, talking about a lot of good things concerning insurance, the different types of insurance out there. We've had other financial professionals with us out of Florida and different parts of the country, and they've given some of their input, which is extremely, extremely important. And today we're going to talk about something very critical. Very critical. It's called annuities, but also we're going to focus on retirement planning. Why? Because I'm about ready to retire. What about you?
We plan on living a long time, so we're going to
You're
need
going to
some
be around
money.
here for a while. So there's people that are interested in knowing what to do. You need to know. You just can't guess. Well, I think I got enough to retire. You know, that $100,000 you have in that 401k, is it really going to last? That 300,000, is it really going to last? You think so? Well, it might. It might. So we just want to talk about that and give you a couple of ideas. We have a guest that's going to be coming on pretty soon. His name is Blake Grant, and he'll be with us very, very shortly. But up until that point, Tanya, I mean, yeah, Flo, you had a little something that you wanted to share, you wanted to read.
You know what? I'm always going to be sharing out of this book here. What we call
They
the
can't see
blue
it.
book is called Saving Your,
There we go. There we go. Save your
Saving Your
future.
Future.
Save your
And
future,
again,
people.
Save Your Future. It's accessible to everyone. Anyone who wants it, just call me or either call Anthony, and we make sure you get your one. Now, of course, everything ain't free, so this is not free. Just for the cost of $4, you can get this book. $4, and this thing is priceless, basically. But you can cash app it to us, or send it to us by check, however. But this is the book, and our topic today it's going to be on annuities, and I'm just going to give a little bit of information. And our guest speaker is, he's going to be one of the experts that's going to talk more about annuities. But just to get you to know what annuities are, you know what? In a way, an annuity looks like a reverse life insurance policy. It looks like a reverse life insurance policy. What do we mean by that? The primary difference between an annuity and life insurance is when payment is made. That is the primary difference. Annuities pay a set amount of money monthly, quarterly, or annually to meet future financial needs, usually in retirement. Now, in life insurance, when does life insurance pay? Life insurance pays the value of the policy at the time of death. So that's the main difference between an annuity and life insurance. We want you to know that and understand that. If you have any questions, our guest speaker that's going to come on today in a few minutes will be able to, answer those questions for you. But again, information, saving your future. Why do we call it saving your future? Because that's what we do. We save people. We save people's future. We like a lifesaver. You put a lifesaver in your mouth. It saved your life, did it not? No, it didn't. But our book can definitely save your future. So make sure that you get your copy of your book. Listen with paper and pencil today. Take dubious notes. And if you have any questions, leave it with us in the comment section of the Facebook. And we'll be sure your questions may go across the page. And if we have time enough, we will answer every question. All right, Tanya, anything you want to add to that before our guest gets on?
Well, I think for those people that haven't been with us, I wanted to kind of go back to what we have done. Our show hasn't been on very long. We've been here for about, 8
6
weeks?
weeks? Yeah.
So between 6 to 8 weeks. And we've had various topics. So we started out with credit, right? You all remember?
Yep, that's right.
Yep. We started out with credit and how to improve your credit. Our main concern was people that were not working and needed to figure out how to stay above ground. And even though they were maybe staying above ground, just not putting their credit in bad shape, and those things that you could do to improve it. So that was our first topic. And we did that for about 2 weeks, right?
Yeah, about 2 weeks.
And then
Right,
we had some business people on, and we were talking with them about kind of the same thing, business credit and moving forward and starting businesses, correct?
Yeah,
Yeah.
and that's extremely important because if you're going to start a business, you need good, you should have good credit, or you should have some credit that's worth looking at. You should know how to, at least if you have bad credit, know how to repair it so that your net worth would rise up. So yeah, extremely valuable. Go ahead, Tanya.
Okay. And so I think we moved from there over to, let's see, insurance. Did we go to insurance net? Oh no, we went to
No, wills
trust.
and trusts.
We did wills and trust.
Wills and
Wills
trust.
and trust was an awesome topic. Now, that made us take it back home to make sure that people had things in order. So Flo just mentioned that a few minutes ago in reference to, making sure that you have some sort of will or some sort of trust in place. And if you all did not catch that, all of our shows are on All Things Relevant Media, and you can go back and take a look at what we had in those topics. We had 2 attorneys on the line with us to give you solid, good information regarding wills, trust, and just your planning for making sure that you keep your property. That was our biggest thing then we were talking about. And then we went into insurance on last week and just giving you the difference between whole life insurance and all of the things that's a part of home life and term insurance and all the different pieces that's a part of that. So again, we invite you to go back and take a look at some of our previous shows. Great information, great guests that we've been having on. And today, I think we have another awesome guest that's going to help us bring in this topic in reference to annuities. And so before your guest comes in, I guess one of those things that, I'm always going to say, I got a story. I don't have a story on annuities because I've been staying away from it, but I know that I want to have a certain amount of income coming in. So I've done all the other things, the 401ks, the savings, saving this and that, but I don't know how that money is going to actually come in or what other vehicle that I can use, because now I am closer to retirement than I am just savings, right? So I think I'm not 65 or 62 yet, but I'm getting closer.
Girl, all right, but you looking good. You look good. You look good to be
Retirement is
95.
not about age, guys. Always remember this. Retirement is about having enough money to retire with for the next 20 years when you retire, or however long you're going to live. Got to have enough money to retire. So it's not about age. A lot of people
Absolutely.
retire early.
And with
You
the
know,
life
a lot of people don't.
expectancy being so much longer now.
Yeah,
So-
well, the average person lives 8,000 days. Let's say the average retirement is 65, right? 65, we agree on that?
Yeah.
The average person lives 8,000 days after that.
After that.
I don't know.
After that.
Give me that in years, bro.
Around 20 years. Around 20 years. All right. So between 20 and 25 years. So now, what a lot of people don't know, there's different types of annuities. A lot of people are afraid of annuities. There's nothing to be afraid of, especially if you have the right type working for you and not working against you. Okay, so we have a guest. His name is Blake Grant. He is a senior regional vice president. Am I correct with that?
I'm regional vice president. Yes, sir.
Regional vice president with
You call it whatever you want.
With AMS. All right, and so he is also, the organization he's in is also one of the network organizations with World Financial Group. And so he is a phenomenal individual. I love his personality, down to earth. I've never formally met him. Well, I haven't met a lot of people these days, except for via Zoom. So I'm gonna give you a Zoom handshake. It's good to have you with us. Good to have you with us, Blake. We're talking about annuities, and annuities can be a really strong vehicle for retirement. So, Blake, we're just gonna open up the floor for you. But before we do, let me answer a question by Barbara Chaplin. Is a funeral policy and a life insurance policy the same? Yes. A final expense policy, life insurance policy, funeral policy, interchange the names, whichever way you want to say it, one and the same. All right. The difference is funeral policy, they may only offer a maximum range of 50,000, 30,000. That may be the cap. All right. Whereas a life insurance policy, in most cases, the regular term or whole life, you're going to be able to go up pretty high. So yes, they are. The amounts, the limits that they will allow you to purchase is different. So Blake, let's talk about some annuities.
Let's do it.
All right.
Well, first of all, thank you for having me.
Annuities, and let's cover fixed index annuities and so forth and so on.
Sure thing. No, first of all, thank y'all for having me. I appreciate it. This is awesome. I got to tell you, this is my first ever podcast. So this is pretty cool.
Welcome.
Yeah. So thanks for giving me the opportunity. And as Anthony said, pleasure to be here. We do work with World Financial Group very closely through life insurance, annuities, different types of annuities. And I think and Anthony touched on it, there is kind of with the general public, and there has been for a number of years, for a lot of people, when you say annuity, it can kind of, create some, defensive posture. And a lot of that is just due to, I think, some misinformation. Look, like any financial service product, in the past, maybe some people haven't had a great experience with them. And a lot of that comes back to what we found is just the simple understanding of what they're getting when they get an annuity. And, for those of you who aren't familiar with annuities, very simply put, it is simply a contract between an insurance company and an individual. And the insurance company is promising either a set rate of return or the opportunity for a certain return. And the client is committing to stay with that contract, anywhere from 5, 7, 8, 9, 10 years, whatever the case may be. But the different types of annuities that we talk to, they can come with market exposure, so they can invest in the stock market. They don't have to. I mean, there's really something for everybody. So I think what I'll start with, especially when we're talking about folks, that are getting closer to retirement, those people tend to start to be a little bit more conservative. Really what you're looking at there is fixed or fixed indexed annuities, which seem to be, the most comfortable and most common. And what you're getting with those types of annuities is three things. First of all, you don't pay anything for them. A lot of folks hear annuity, insurance product, they think I'm paying something every year. Most fixed and indexed annuities absolutely come with no fee, right? So I'm not paying anything for it. Second thing, I'm guaranteed to never lose a dime. Okay, so even if
Hold on, wait a minute, Blake. Let me interrupt real quick.
Yes, sir.
Did I hear you say correctly that if I get a indexed annuity, I'm not paying anything for it?
Correct.
All right, now, folks, listen to me. You heard that, right? Now, I know y'all have questions. I know you got folks, send in your questions, all right? Because I know some of y'all are saying, this is too good to be true. Well, let me bust your bubble. No, it's not too good to be true, right? I know y'all have questions.
So Blake,
send in your questions, all right? Because I know some of y'all are saying, this is too good to be true. All right, so I don't know where we're getting the echo. Somebody's watching it on their other screen.
Yeah.
But listen, this is extremely important topic. This is too good to be true. All right, I don't know where the other, who has their phone on or their tablet on along with it. There you go. All right, now here we go. So this is important.
So Blake,
this is important.
Tell us.
Go ahead, Tanya. You had a question.
Yeah, tell us from square one. So, a person, I don't know whether or not it matters with age, but if they wanted to do an annuity, where do they start? How much money? Because I think that's what people don't know. They think that you have to be wealthy in order to start an annuity. So if you can help people understand, where is the starting point?
Yeah, that's a great point. And generally speaking, and again, every carrier and every product might be a little bit different. But when you're talking about a fixed or a fixed indexed annuity, you're generally looking at an initial purchase payment of around anywhere from $10,000 to $25,000, right? So especially if you're 50, 55, we're generally looking at retirement or near retirement monies. We get a lot of rollovers from 401ks for some of those dollars. IRAs that maybe have been sitting in cash for a number of years. But generally speaking, it's going to be in that $10,000 to $25,000 range. And again, it depends on the carrier and really that client's specific need and what they're looking for. Great question.
So once they take that out and put the 20 or 25 or 10 to 25,000, will they have to put more money in it each month or just leave it?
No. So there's really two kinds, right? So we can do a lot of different things. Most annuities are single premium, and that just means you pay one time. So whatever you put in up front, that's it. There's no monthly billing. There's no additional requirement, anything like that. It's basically a set it and forget it type product. Now, there are some annuities that are what's called flexible premium, which means those contracts can take additional premiums, but it's not a requirement. I mean, you can buy a flexible premium annuity and never put another dime into it. The one thing you have to do, though, is make sure you have enough money to get it started, right? So whether that's 10 to 25, no matter if it's flexible or single premium, you have to have at least that amount of money to at least open the contract.
Okay, so then tell them I'm sorry, Matt. Okay, so then tell them what happens to that money when it's sitting there, that $25,000, if they found the $25,000 or $10,000, what's happening to it? Why is it a good thing to do and put the annuity in?
Yeah, so a few things. And again, I'm going to talk about the fixed indexed annuity, which does not necessarily come, now it has a guaranteed rate built into it that you can put some of your money into it. But generally speaking, you've got 3 or 4 options within that contract that you can put your money and spread it out, right? So think of the annuity as kind of an umbrella, and then underneath it, you've got a few more options. Each one of those options is going to give you opportunity to grow that money, generally speaking, through performance in the stock market. But let me say this, that money never goes into the market, right? All we're doing as an insurance company, as an annuity company, is we're tracking that performance. And what they'll do is they'll say, okay, were there gains in this contract over the course of the past year? If the answer is yes, they will earn X amount of money. And I'm not going to quote numbers, but it just depends on the strategy, the pricing at the time. But on average, they're going to earn in a good year, anywhere from 4.5% to 5%, right? But if there was no growth in that strategy or it went negative, the worst thing that happens is they get a zero, right? So there is no harm to them. And then the last piece of that is every time they earn some money, and most indexed annuities credit on an annual basis. So let's say I had a 7-year fixed indexed annuity. Every anniversary, I'm either going to make some money or I'm just going to stay pat and get a zero. But every time I make money, I get to keep that. No matter what the market or my crediting strategy does that following year or the ensuing years, that money I've earned is mine to keep. And that is a huge thing for a lot of people, because what we're doing is we're taking away that risk of market losses. And when you take out market loss, you don't have to take that much time to recover. There really is no recovery in that environment. So that's something that's really huge. And I'd be remiss if I also didn't add the fact, because you say, what's my money doing while it's in this contract? It's also growing tax deferred. Right.
That's right.
And what that means
not paying taxes on it.
is I am not paying taxes on any earnings on an annual basis. So if I'm in a bank product and I'm making point nothing, like I might be in a bank right now, right? Most banks, if I even make $10 in interest at most banks, they're going to send me a 1099, and I've got to file that with the IRS when it comes tax time. Even $10. I like to call that my annual insult, right? Thanks for banking with us.
Thanks for banking.
Here's the $10 we paid you. Now you got to give some of it back to Uncle Sam. In an annuity, when we say tax deferral or tax deferred growth, that money grows tax deferred, meaning we're deferring that tax bill either until we take the money back in hand in cash at some point, or when we pass away, and it'll go as a taxable benefit to our beneficiaries.
All right, Grant, Blake, excuse me, we have a question for you.
Yeah.
All right, it says, I have been retired for 10 years and have some fixed annuities that have done well. I understand that I am required to make withdrawals once I reach the age of 72, actually before age 72, before 72 and a half. If this is true, where do you recommend I put this income besides the stock market?
Great question, Cheryl. And it looks like her name was Cheryl Grant. I don't think we're related, but you never know. Cheryl, everybody's situation is a little bit different. But the thing with RMDs, and that's what you're referring to as required minimum distributions when you reach that 72 and a half age, that's Uncle Sam's way of saying, we've let you grow this money all these years, basically tax deferred, but now we do have to collect some tax. So they're going to make you take those withdrawals, whether you need that income or not. A lot of folks don't need it or don't want as much as they're required to take. So there's a few different things you could do with it, right? You could take some of that money and you could put it back into an annuity, right? And let that continue to grow tax deferred. At that point, there would be no more RMD or required minimum distribution on that. You have a lot of folks that might take some of that money and fund life insurance. You might take some of that money and just go have fun with it. Every client is going to be a little bit different. But if you're at that age of 72 and you're feeling like, hey, I need to start being a little bit more conservative, you're exactly right. In a lot of cases, we're probably not going to go put that back in the market or in riskier type of investments. But there are plenty of places you can put that money to keep it safe, but also not give up on the growth opportunities going forward. Because as Anthony said, if you're 72, you're probably going to live at least, women are going to live longer than men. So you probably still have a good number, another, 15, 20, 25 years. So,
Tell them. So, Matt Flo, you wanted to go next? Because I do have one more question.
Yeah, I had a question. Blake, thank you for being here for one thing. I mean, the information is awesome. Very critical for our guest that's watching. Explain to them about if they does the money have to be qualified or non-qualified? And I know a lot of people don't understand those two terms right there. If you kind of break it down, they can understand what non-qualified and qualified money is when they're trying to get an annuity.
Yeah, thank you for that. And again, appreciate y'all having me. This is actually a lot of fun. Like I said, it's my first one, so it's pretty cool.
Well, we got to have you back.
I feel kind of important. It's been a while.
You are important. You're a man making a difference.
So to answer your question, Mad Flow, annuities, we can use non-qualified or qualified monies in annuities. It doesn't matter. They'll take either. But to your point, the question between non-qualified and qualified is this. Non-qualified means you have already paid taxes on that initial premium. So it's after-tax dollars. Qualified means that money has never been taxed. So as an example, what a lot of people will relate to is a 401k, right? That money, you've contributed to it, your employer might have contributed to it, and over the course of that time, it's grown, right? And it's been in qualified status. You've never paid any taxes on those initial dollars or on the growth. So when it comes out, all of it is taxable. When you have a non-qualified account, when you start taking money out of a non-qualified account, you will only pay taxes on the growth because that has been growing tax deferred. So, I mean, the way to think about it is this: Uncle Sam's going to get his one way or the other, right? He's going to either get it on the front end or the back end, but he's getting it. But qualified basically means I've never paid taxes on any of this money. So when I start to take it out for income purposes, I'm going to have to pay taxes on everything I pull out. If it's non-qualified, it means I've already paid taxes on my initial premium. Some people will call that a cost basis, but I will pay some taxes on any growth that has occurred in that contract.
All right, Blake, I have a question.
Does that answer the question?
Perfect.
Okay,
I'm pretty sure everybody out there understands that now.
I have a question for you.
Yes, sir.
Can an individual who has qualified monies, all right, can they roll those over from a 401k into a fixed annuity and still defer the tax, or will they pay tax on that during the rollover? They will not pay tax. All right. No. You understand what I'm asking?
Yep, great question. So I'll just talk about transfers real quick. And there's qualified plan transfers, and then there's 1035 exchanges, right? And we just touched on the qualified versus non-qualified. But if you're talking about money that's coming out of a 401k, and if we're taking that money and moving it right into another qualified plan, so when it leaves the 401k and it goes into a fixed annuity or fixed indexed annuity, it's now basically a traditional IRA. And what the government allows for is non-taxable transfers of those types of monies from one product or one housing mechanism to another. So you're exactly right. If I've got a 401k and I want to roll it into something else that's qualified, I will not pay taxes on that transfer.
Go right ahead. I'm sorry.
I was just going to finish up. The non-qualified transfer is basically the same thing, but that's called a 1035 exchange. 1035 is part of the tax code. And that basically says the same thing. If I've had an annuity, or I've been growing some of my money tax deferred, and I want to move it into another tax deferred product, I can do that with no tax liability through what's called a 1035 exchange. So you've really got a qualified plan transfer, and then you've got 1035 exchanges. And in both scenarios, nobody pays taxes on that transfer.
All right, Blake, let me ask you something here. Say an individual has $400,000, $500,000. They got this money. This is for their retirement. All right. Now they roll it over into an annuity from the 401k. They will only pay tax on, now they're going to start taking distribution, right? Because they're retired, they need some money, all right? They're going to start taking either monthly or annual distribution or quarterly, whatever, all right? They're only going to pay tax on the money that is distributed?
Correct. Yes. So let's say that scenario, you have $500,000 in a 401k. You move the $500,000 into an annuity or any other type of product that's still qualified, and they start taking out 5% a year, right? So they take out $25,000 a year. That full $25,000 will be taxable.
All right,
but nothing else. But the rest of it, as long as it's still held in that qualified plan, is going to continue to grow tax deferred.
All right. Now, folks, look, that is extremely, extremely, extremely important. You have money you want to roll over. Guess what? You have 3 people here that can help you with that. And we can help you anywhere in the United States of America. All right. I don't care where you live. If there's a town in America called Timbuktu, we could help you with that. We can still help you. I believe Flo had a question for you. Flo, go right
Hey,
ahead.
Blake, in reference to that 72.5 penalty, they have to do a required distribution, which means they have to pay themselves by the time they get to that age, don't have to go over that age. How long does that penalty happen if a person, say they start taking money out at age 73? How long would that penalty last?
Well, so I want to clarify. So there's at 72.5, there's no penalty. There's no penalty. It's just you have to take that money out.
There's no penalty.
Yeah, there's no like extra.
Okay, you have to start taking the distribution to yourself.
Yeah, they have to start taking that required minimum distribution, and the number will change. So every year on your R&D, you have a factor. And forgive me, I don't have the numbers right in front of me, but in that first year, let's say it's 3%. So in the first year of retirement, you've got to take, and again, I'm making this up, but let's just say you got to take 3% of your qualified account. As you age, that number is going to go up because, again, what the IRS and what Uncle Sam are saying is we've let you grow all this money tax deferred for all these years. Look, it's a spend down program. They basically want you to spend it to zero. Okay. That way they can recoup all that tax deferred advantage they gave you for 40, 50 years for as long as you worked.
Wow.
Right. So, but that's why when we look at annuities, and we didn't touch on this because we're trying to keep it simple, but some annuities, some index annuities have income riders associated with them that will pay you for life, where you will never run out of money. So whereas Uncle Sam says, I want you to go to zero by about the time you're 85, basically your mortality, right? 85, 86, you can purchase an annuity with a lifetime income rider and basically make those payments last for as long as you live.
So if a person lives to be 95, 105.
Say that again, Anthony. I'm sorry. And then Tanya had something to say too.
Oh, well, you know, Tanya has a lot in her. And I mean, she's, man, listen, I'm telling you, we let her go and I'll just sit back. Just real quick, regardless of how long they live. I want to make this dummy proof. I'm not saying anybody dumb. This is just for me. Okay. Right. If I have an annuity and I live to be 110, I got the annuity at age 70, and 72 comes around, boom, I start taking distribution, and I have the lifetime, I have the income rider.
Yeah.
All right. Understand the term, people, income rider. Is that correct?
Yes, sir. You got it. Right. It's a rider. And that's why I said you will pay for that. That's the only time you'll pay for something on an indexed annuity is if you're trying to pay for that guaranteed income piece of it.
Yeah, but who cares? I mean, it's going to pay you the rest of your life, even if you outlive the amount of money that you put in. So if let's say you put in 400,000, all that money is exhausted. You live to be 110, 15, and they're still paying you. So in essence, you could end up being paid $1.something million because you outlived the money because of that one little thing called income rider. Tanya, go right ahead.
That was great. Okay, so I just had a question come on my phone where someone was asking, well, what is the real benefit of them moving from their 401k into an annuity? So I was going to go ahead and let you answer that.
Yeah, so that's a great question. And the first thing I'll tell you is it's control, right? If you leave that money in the 401k, you are limited to what you can do with it in terms of what that plan offers, right? They may or may not also offer withdrawal privileges, lifetime income riders, things like that. So a lot of times when people, because you're still getting tax deferral, right? So from a tax efficiency standpoint, there's no difference. But when you take it out of that 401k and you put it into a traditional IRA, right? And you can buy annuities, you can buy all kinds of stuff under that umbrella of the IRA. You've now taken control of that asset, and you can decide how it's invested and what your investment options are, whether that be annuities or mutual funds or things of that nature. And again, when you move it out of the 401k, you also give yourself the opportunity to get certain things like lifetime income riders, guaranteed death benefits. You can also eliminate a lot of that market risk, because when you're in a 401k, that account can go up, down, whichever way it wants. If you're in an annuity, in an indexed annuity in particular, we know it'll never go below zero, right? So if I start with 400 or 500,000, the worst thing I'll ever have is 400 or 500,000. If I'm in a 401k, I may have 500,000 one day and 250 the next. Go back to 2008, right? I mean, a lot of people are supposed to have their retirement. That's right. And so it's really about control and security. Great question.
Okay.
Folks, what other questions do you have out there? I don't want you guys to wait till it's 5 minutes of, and we're getting ready to close down, and then all of a sudden everybody texts me. Look, send us like Sherelle did. Send us your questions. I almost wish we had phone capabilities so that we can hear your voice live, because this is important. You guys need to be on the phone calling your neighbor, your friend, your enemy. You're calling everybody. Go ahead, Flo.
Hey, Blake, what age can a person get an annuity?
That's what I was going to ask.
Yeah. So again, it depends on the carrier. You have some that you can start as early as birth. Although, that may or may not be appropriate, but maybe in some cases where somebody's inherited some money and they want to just kind of sock it away. Generally speaking, while we have very young minimum ages, most people who purchase annuities are getting closer to retirement. So anywhere from that 45 and up, 50 and up range. And again, it kind of goes back to depends on the type of annuity and really how much risk tolerance do they still have, in their appetite and what they're looking for as far as growth.
All right, to make sure I understand this, any money gained in this indexed annuity is never lost.
Correct.
All right, folks, listen to me, because 2008, 2009, I cried, boy. I cried. I didn't have an annuity. I had it in something else. And $10,000 was gone. I was like, oh, Jesus. I didn't know what to do. I was like, oh, my God, man, oh, man. Listen, you don't get that back. People think they're going to get that back. But what happens? Your money, let's say this is the even line right here. You're in that 401k and your money starts going down. By the time your money starts coming up, and here's the annuity rising simultaneously, you get back to zero. Guess what? The annuity is already here. You just got back to zero. All right. So now you get above zero, the annuity is up here. So I'm not saying that is the answer to the world, but I am saying that they are safer than a lot of vehicles. Go ahead, Flo.
Okay.
I saw your finger all over the place. Go right ahead.
That's the way we roll. Blake, now we know there's two phases of, two phases in annuity. One is called the accumulation phase. Now that's when you're putting the money in, correct?
That's when you put the money in, and all it's doing is like it says, it's just growing, right?
Just growing.
We're growing towards a certain date or a certain age or whatever the case may be. You got it.
And then there's the payout phase. Now we talked about one phase that people, I think they got a good grasp on it. But could you go over real briefly on the other phases, the other type phases that payout phases that is available for those? We went over the lifetime payment. Could you just touch bases on the others so they can give them an understanding that there's more ways that they can take their money out when they're ready to annuitize their money? Yep.
So a couple things. So we talk about accumulation phase and then the income phase or the payout phase. And when we get to the income or payout phase, you have, like you just said, you've got a lot of different options. So if you are using a lifetime income rider, that is generally speaking a withdrawal, right? So we're just taking withdrawals. We still have control of our original asset. The other thing you can do is actually annuitize that money. And what annuitize means is you say, I'm turning this into strictly an income stream. And what I'll get is I'll get some growth in those payments that'll be taxable. And if we're talking about qualified, it's going to be taxable. But in non-qualified assets, if you annuitize, some of your payment will not be taxed. Some of it will be. So annuitization can come in a lot of different phases. People can do it for life only, meaning it's going to pay out until you pass away. You can do it life with a 10-year period certain, which means it'll pay for at least 10 years or lifetime, whichever is longer. So you have a lot of different options, and everything's going to be a little bit different because at that point, you also want to look at kind of what the tax sort of the taxable income stream may or may not be to that person. But just understand when you get to that payout phase, you really have many different ways you can go. But to kind of keep it simple and to just put it into two buckets, you can either do it through lifetime withdrawals or you can turn it into an annuitized payout. Now, the one thing when you annuitize is you no longer have that original asset, right? All that money goes just into like what we would consider a traditional pension payment.
Gotcha. Okay. Cheryl had a question. Ms. Grant had a question a few minutes ago, and it said something like, would it sound reasonable for me to give my monthly RMD to my 37-year-old son and let him invest it as he would like to?
I want to be that 37-year-old son.
That is a personal.
Yeah.
Go ahead, Grant.
Go ahead, Grant.
Look. Yeah, you can do that. I mean, I can't. I'm not gonna say is it reasonable or not. I don't know you or your son. I'm sure you're great people. But yes, you can do whatever you want with that money. Now, depending on the size of your RMD, and I'm not a tax professional, so I'm not giving tax advice. But depending on how much you give your son through the course of the year, you don't want to exceed any kind of gift allowance where it would then become a taxable payment to your son. So that's the only thing I would say is just double check, make sure if you're going to turn that money over on a monthly basis that it doesn't that it's not so much that it turns into a gift. But yes, if you don't need the money and you want to help him, invest monthly and build up his future retirement, I think that's phenomenal. There's absolutely nothing that would prevent you from doing that.
Cheryl, realize that your 37-year-old son is probably watching this show right now, so don't be surprised if he takes a right down and contact you.
That is such a personal decision. I would definitely say get together with your tax professional and discuss that for the tax consequences on that. But as Grant said, you don't want that to turn into something else. At the same token, Sherelle, and I don't know if you're a man or woman, because I have a friend named Sherelle that is a man, but same exact spelling of your name here. If you need, and I highly recommend this, if you need a financial checkup, we are more than capable to do that for you. And as we mentioned when we were teaching insurance, that it is extremely important to have an annual financial checkup. You have 3 professionals here that could do that, actually 4, but 3 hosts that could do that. And we can help you anywhere in the continent or anywhere in the United States of America. I'm not licensed in Canada yet, but I'm getting there. Listen, this has been valuable. I don't know if we're going to be able to address everything in one sitting. We may have to. Go right ahead, Tanya.
I was going to ask one more question in reference to.
Oh, you have more than one more question. All right, go right ahead.
Of course I do. Okay. So, Blake, does a person need to wait until their retirement in order to do it? Or could they move that money from their 401k at any time?
Yeah, so that's a great question. Most employers or 401k plans these days have what's called an in-service distribution. that will allow for a certain amount of that 401k asset to be moved out into a vehicle of their choosing with their financial advisor, without, again, any kind of tax penalty or tax consequence. It's called an in-service distribution. Like I said, more and more plans allow for that, but it's going to be different with every employer. But we do see a lot of folks do that, especially as they're maybe nearing retirement, but they're with that same employer, and they say, "Hey, I want to start taking control of this. I'm allowed to take X amount out each year and do with what I want." That's a great question, and they can absolutely do that as long as that particular plan allows for it.
Yeah, you have to really check if you're still employed. You must check with your employer, human resource department or benefits department, and make sure that they have an in-service distribution acknowledgement, so that this way you can move that money as needed. Because if not, and you want to roll that money over, they'll say no. They will stop you right in your tracks, and I speak from experience with that. So it's extremely important. It's just a simple question. Whoever is in charge of your benefit, your 401k, if you're still working, you contact them and ask them specifically. Don't beat around the bush. This is your money. Specifically, do you allow in-house service? All right. I've been watching the show. Please bring Blake back. The guy is a wealth of information, knowledge. He is not an attorney, but he is good at what he does when it comes to taking care of and I can't see the rest of the question because of my computer's acting.
Says when you come taking care of your money, bring him back, please.
Bring him back, please.
Blake, you're doing good on your first show.
Hey, listen, can we come back too?
I'll come back whenever you need me.
Blake
show. All right.
So where we are is that we've only talked about one aspect, and that was a fixed annuity. And so we know that this is very important, and we might as well, already say that next week we're going to talk about annuities again, and then maybe we can get to the other side of the annuity, which is the variable side of the annuities, and have questions and people being able to get more of an understanding of either side that they choose, So that will say, hey, Blake, are you available to come back next week and join us?
Let me just check the calendar here. I think so. I appreciate that.
You see how fast that time went by?
Look at
now. But see, now I feel all this pressure. Now I have expectations. I don't know.
Good.
I should probably just do the one time and be done with
it. He was good.
And I had
that should not be a problem. I can do it again next week if you like. Absolutely.
Great.
Okay, Blake, my last question from my phone that they won't put online is, can they will this money on the fixed annuity? Can they will that money to someone as it keeps coming in? Is there any way to will it?
I don't quite understand that as it keeps coming in. Yeah, so I'll try to answer the best I can if I understand the question. On every annuity, you will have a beneficiary designation. You can have a primary beneficiary, and then you're going to have contingent beneficiaries. So let's say I'm an annuity owner and I pass away with my annuity, and I've listed my wife or my kids as my primary beneficiary. They would then receive that lump sum. Now, I just realized as I'm talking through this, they may be asking about the income stream. If you're saying if I've been taking a lifetime's worth of income and I pass away, no, it's just for life, right? If there is any residual for that person, otherwise, man, we'd be stringing these things out forever, and that ain't gonna happen. But you can do that with a spouse in most cases. So if I'm on it and I'm taking, either if I'm taking single or joint income, if one of the spouses passes away, in most cases, I'm qualifying, in most cases, that surviving spouse can continue that income stream. But generally speaking, you're not going to have a way to continue that lifetime's income for a child or some other beneficiary.
Right.
All right. And now something very important too, folks, that I want you to realize with the annuities that I deal with anyway, and some of the annuities that's offered, a lot of the companies now are offering sign-up bonuses. So it could be 10%, 15%, 20%, whatever. So let's say you had money in a 401k, but you lost a bunch of money. And now you want to roll it over into an annuity where you go to the right annuity, you might get a sign-up bonus of 15% or 10%. And doing that, you will recoup some of the money you lost during the term of it being a 401k. So with that, hey, look, you guys, there's a lot in this area. There's a lot. I want to make sure you guys understand how important financial literacy is. You know, these are our financial sins, right? This show is for you. This is your show. This is not our show. It's not my show or Flo's show or Tanya. This is your show. We're here for you. All right. Because if your money goes awry, then what? Then what? If you outlive your money, then what? And most people outlive their money. Now what? So we need to answer and ask these questions. You need to ask questions that you're not you're afraid to ask. Those are the questions you need to ask. I think this question is going to sound stupid. That's the best question to ask.
Absolutely.
That's the one that we need to hear.
So we'll be back next week with Financial Sins, and we hope that everyone will join us. Blake, we want to thank you so much for being with us on Financial Sins on the week of April 16th. It's important to keep these dates. April 16th, we did annuities and retirements, and we had Mr. Blake Grant here with us. And again, we thank you all for joining in with us, and we'll be back next week talking about annuities and retirements again. Flo and Anthony.
I got some last words, Tanya. I got some last words. Folks, like us on Facebook. Spread this around, All Things Relevant Media. Tell your friends about All Things Relevant Media. If you want a book, Save Your Future, let Flo and I know. We will get one to you. Our numbers scrolled across the bottom. If you want an insurance class, get together with Tanya. Don't hesitate. You may not want to get your license, but you just may want to know the information. Tanya has a school, right? Would you believe that? A school. Yes, professional. That's what professionals do. We teach people. So I want to thank all of you guys for being with us today. Flo, any last words? We got 30 seconds.
Hey, Blake, I just want to say you got a nickname now. Jackson John is calling you Mighty Blake. The Mighty Blake.
I'll take it.
I like that.
Thank you for coming in, the Mighty Blake. This is All Things Relevant Media. You guys tune back into us next week. Okay, same time, same place. We sure enjoyed it.
All right.
Thank y'all. Had a great time.
Thank you, Mighty Blake. The Mighty Blake.
The Mighty Blake.
It's going to stick. The Mighty Blake. We're going to change the name next week to Mighty Blake. It won't be Blake Grant. It'll be Mighty Blake.
Oh, man. Here goes my head.
With a cake.
Yeah, blow it up.
Bye-bye.
Bye-bye. Thank you.